Welcome to the Multifamily 0 to 1 online meetup, where we discuss the best strategies to get started in apartment syndication.
Thanks again for everybody for joining us. If you're new here, this is our Multifamily 0 to 1. Today we're talking about our edition is passive investors. So our focus is how can you get started as a passive investor in multifamily, and which is very important even if you're looking to be a syndicator, to kind of understand what are the important criteria for passive investors, because ultimately they're going to be the ones who you're going to be catering to.
Before we get started, I just want to remind everyone that this is an educational presentation and we're not making any investment recommendation. You should always consult with your CPA and attorney for financial and legal advice.
Let's just go ahead with some introduction. So for those who don't know me, my name is Marcelo Cazini. I'm here in Houston, Texas. My background is in IT and software development and project management. I'm a local Houston CCIM member, and I've completed all the CCIM designation trainings, which is a commercial investor designation. I'm a multifamily investor. I also own and operate my own commercial real estate. And before doing commercial real estate, I was involved in single family fix and flips.
Hi everybody, this is Claudia Rubio. We are also based out of Houston, and I was born in Colombia, South America. We've been living here in Houston for 7.5 years almost, and I have been doing real estate almost my whole life since I was very young. I've been managing my own assets in Colombia. I have an architecture degree, and right now we are managing our first syndication here in Houston. We acquired it almost a year ago, December last year, and we're here looking for our next syndication.
And I'm Martin Rubio. I'm an IT security consultant. I've been doing that for around 25 years, but on the side, since we met with Claudia and even before, we both have been working in real estate. Claudia has a lot of experience on the asset management side. I have experience on the business creation and running side of things with my consulting firm for a long time, and many other businesses around it we've had. We have been in multifamily for the last 2.5 years, and we currently have ownership in around 800 units in Texas and Arkansas.
All right, thanks Martin and Claudia. Alan, do you want to go ahead and introduce yourself?
Yeah, my name's Alan Neely. We're from Seattle, and we started investing in real estate in basically 2000. Pardon?
Somebody needs to get.
Yeah, so we started investing in real estate in about the 2000s. By trade, I used to be an airline pilot, and I just realized mainly after 9/11 that this career isn't much of a guarantee. So we started to invest to build wealth outside of the airlines. So we picked real estate. We started building townhouses. We kept them all as rental properties. Started a property management company. It becomes very management intensive. So now we're really happy kind of taking a back seat and being passive investors. And in the last year, we've purchased or invested in around 1,450 apartment units. And so far, it's been going really good, even considering COVID. It seems to be fairly smooth sailing for most of the properties. So we're pretty happy.
Let's get started, Alan. I wanted to ask you, you already mentioned briefly that you didn't start with multifamily when you started investing in real estate or doing real estate. So why multifamily? What was the most attractive thing about multifamily to you?
The biggest thing is if you have one vacancy out of 100 units, you're still 99% occupied.
Mm-hmm.
With single family, you know, if somebody moves out and you're trying to clean it up, repaint the whole house for a turn that's vacant for a month or two, and you have, no income at all.
Mhm.
And there's just safety in numbers, and you can hire a professional management company to manage it, so we don't get any phone calls on our multifamily stuff. Uh, it's just a completely different world. It's much easier, much more passive.
Mhm.
Those are our biggest reasons. It's easier to own out of state too, because you could hire a very reputable property management company, or with single family, you don't know who you're going to have managing it
Right.
out of state. Yeah.
And you being based in Seattle, is
Yeah.
Washington a landlord-friendly state or not really?
Pardon?
Is Washington a landlord-friendly state or
Oh,
not really?
that's huge for us. No. We've been watching Seattle really turn in the last 5 years, and it's getting really tough with the landlord-tenant laws. They passed this really great law for tenants. The first qualified candidate to fill out an application, you have to rent to them.
Oh, wow.
So if they have a criminal background or whatever, you can't look into that. You just have to rent to them.
Wow.
So you don't get to pick and choose who your tenants are. So if you have a duplex or an eightplex, you really don't want a sex offender moving in, but there's no way to stop it.
Wow.
You can't do a background check for it. So things like that are really tough.
Yeah.
And yeah, I could go on and on and on about Seattle right now, but I won't.
Right. It's a good thing you're in Hawaii today.
Exactly. We had to escape.
Can I jump
Yeah.
in?
No, go ahead, Marcos.
Yes, your comment about some rule about having to rent to the first qualified applicant.
Yeah.
Isn't that the case in every state? And I want to speak specifically to the criminal piece of what you just said, and say if your application, not your application, your requirement process, your requirement identification, whatever you want to call
Yeah.
it, explicitly says no criminal record. I mean, so I'm saying two things. I thought that
Yeah.
every state you absolutely can't discriminate. You have to rent the first qualified applicant. So could you clarify on what you mean by that? Because I don't
Yeah,
want your
so like in Seattle during the good times, you might get 10 applications for one property all in the same day, and you kind of just look who's going to be the best fit, who do you get along with the best. So you could, you just pick whoever you think is the best and then call the others and say sorry. And then for the criminal part, it's really tough because you're not, their criminal history might show up on the background check, but you can't use that as a reason to not rent to them. What a lot of landlords are doing in Seattle is you just set your minimum qualifications so high, like a credit score of 800 or 750, that you can turn down everybody and still comply with the law, but you might pick somebody with a credit score of 700 just because you like them and you think there's a good reason why their credit's been hit or whatever.
Right.
So people are finding ways around it, and we only have 8 units left in Seattle that we rent. It's 8 townhouses all on one big lot. So, and we still manage it ourselves, and it takes up most of the time, and cash flow wise, it's the smallest reward. So
Right. Yeah, I'm sure it's not difficult to find criminals with good credit scores, right?
yeah. Yeah,
Okay.
typically they don't. Yeah. And we've always built new construction townhouses in nice parts of Seattle, like Alki Beach or a place called Green Lake. So it's mostly, we call it yuppie housing. It's our rents right now are between $3,500 a month and $4,000 a month. And it's 3-bedroom and 4-bedroom townhouses. So we really don't worry about the criminal part, because criminals really don't fill out our applications.
Right. Okay. So when you were looking into multifamily as an option that was more interesting than what you were doing, there's a learning curve, right? You have to learn what's different in multifamily than single family.
Yeah.
How did you approach that learning? Did you do it on your own? Did you find a mentor? Did you read books?
I tried for 2 years to do it on my own. I wasn't getting very far at all. And then I think I can mention his name here, Brad
Yeah.
Sumrock. I went to something he was talking at in Seattle, and it really resonated with me. And then as soon as we joined his group, I'd say within a month we had 3 or 4 deals we could invest in if we wanted to. And we kind of picked and choose, and yeah.
Okay.
Go ahead, Marcos.
Go ahead.
Yeah, I had a question. So I'm kind of in your shoes where I'm actively looking for GP deals to invest in. I've invested in a few in the last year, and I'm curious what you said about after you joined the summer group and how it started identifying deals right away. What were your challenges in finding valid deals to invest in? Because I'm not having a problem, and I was just curious what was kind of the challenges you were experiencing prior to joining.
So for us, we're in Seattle. And so I could find deals all day long in Seattle, but what we've learned is that the appreciation in Seattle made us wealthy, but you can't retire when you're making a 1 or 2% cash flow on your equity. So you might have a few $1 million equity, but when you're only making 1%, you can't retire on that. There's no money to spend. So we wanted to move to Dallas or move our investments to Dallas or, landlord business friendly municipalities. For whatever reason, they have much higher cash flows. So we could not find any deals in Texas, living in Seattle and not having been there, and we didn't know anybody. Now, since COVID, there's all kinds of meetup groups like this one. I mean, this is great. Everybody from out of state can meet syndicators and find a deal.
Right.
Or you just keep in touch with everybody on this forum. Yeah.
And I would add, Marcus.
My number, if you ever get a deal, call me.
Yeah, I would add for Marcus, it's very common to see a lot of deals go by, even if you're not in any group. We see a lot of deals go by outside of the Sombra group and all that. And so every deal that we send or anyone sends, it's a sales pitch, right? So they all look amazing, but you won't know how they really perform until the full 5 years and they sell and all of that. So that's kind of where the question was coming from. You need to get educated to really understand what they're selling you. So Alan, after you joined Brad, how long did it really take you to feel comfortable and take one of those deals and invest?
It was probably less than a month, so we'll just call it a month. I went through Brad's training really fast.
Okay.
I understood it all because, we owned a property management company, just not to the level of apartment buildings. So it all transferred pretty well. We had a lot of deals to choose from, and I said no to 3 or 4 before I said yes to the first one.
Okay.
And the first one, we said yes to it mainly because we liked the lead syndicator.
Okay. And you were focusing on the Texas markets, right?
Yeah, we focused on Texas. We also bought one in Florida and one in Arizona.
Okay.
And it's interesting seeing the differences. It again goes to landlord business friendly environments, and Arizona is not very friendly any longer. It used to be, but things are changing there pretty quickly. So they have really high economic vacancy. A lot of people just aren't paying rent or paying full rent. We're collecting about 82% of the rents. So it's kind of tough. It's still cash flow positive, but barely.
So you mentioned, Alan, that first deal, when you were comparing and contrasting, mostly was because of the syndicator that pushed you. But so can you tell us a little bit more about that first deal? I mean, where Like how many co-sponsors and what location, number of units, and maybe what attracted you to that particular syndicator, so that maybe other people can emulate their qualities.
Yeah, the easiest part, what attracted us to the main lead syndicator is we know him from Seattle. We met him through Sunrock. We had lunch with him a few times, and we just, well, as soon as you meet him, you just know if nobody's watching, he's going to do the right thing. There's no doubt in my mind, I don't need to worry about fraud or any of that, which to me is, at some point you want a certainty of your funds are safe more than a huge return.
So you thought they were trustworthy?
Yeah, he's very trustworthy. And then the project I kind of like because it needed a foundation repair and things like that. There were some things that in their pro forma that I didn't agree with. I thought it would take longer to get all of their units online and do the foundation repair, and then COVID hit and it really drug it out. So is it performing per the pro forma? No, but given everything, we're fine with it. They're already looking at selling it, and it's only been a year and 3 or 4 months.
Mm-hmm.
They might sell it in the next 6 months, and they'll only sell it if it doubles the investor's money. So
What kind of loan do you have in that deal?
it's,
you remember.
I really don't remember.
Mhm.
Yeah, it'll take me too long to look it up.
No.
No, it's okay.
Yeah, I'm just passive on that one. But you know, it's your typical Fannie Mae
Yeah.
20-year or 30-year amortization. There were a couple of years of interest only, and I don't think there was any prepay on it, prepay penalties.
That's why I asked. Yeah.
Yeah.
And Alan, how many units? What class is it?
Oh yeah, so it's Class C. It's definitely Class C, workforce housing, outskirts of Dallas, DeSoto, Texas, if you're familiar. It was 172 units. It's a bunch of like 16 plexes or so on a pretty sizable lot. But it's definitely C-class property, C-class neighborhood, mostly Hispanics. But it seems to be going okay.
And Alan, I was going to say, you are not to be blamed for not knowing your debt service on that, because you are a limited partner, right? That's the whole point of us being limited partners. We don't care. Did or did. Get me my money back that you promised.
Yes, somewhat I care because, yeah, I'm looking at deals now to buy one, and there's some of them that are coming with debt service, huge prepayment penalties, and you know, it's 4.5% interest, which sounds great, but you're competing against people buying it. They're going to put 3 3/4 or, you know, sub 4% financing in place.
Yeah, no, I think it's just, that's the difference, right? When you are trying to go away from being a limited partner and into a general partnership level stake, and you're evaluating deals for where you will be the one operating or being the signer on the deal, or being someone responsible for other people's money and its performance and asset management and property management and project management and all of those things, and potentially handling legal issues that come up through your legal team or whatever the case may be, right? When you have that much overhead and that much responsibility on you as a GP or a co-GP, then it makes a lot more sense to deep dive into every little nitpicky facet of that deal.
Right.
And start remembering things and start writing them down and know it off by heart. But as a limited partner, I mean, I'm a limited partner in 6 different deals. And if you ask me about any one of them, I couldn't tell you the asset count, unit count, deal structure, 80-20 split or not, I don't know. When I evaluated
it was just me.
No, it's just, I feel like that sometimes. I feel like I'm the only idiot who doesn't remember any of this stuff. But I just feel like if I did the due diligence at the time of investment, and I was comfortable enough with the syndicator, the asset class, the location, the unit counts, the business plan, truly what they have in place. And I vetted the people that they had listed on those business plans of the teams they were going to use or the builder they were going to hire or whatever their major stuff was. if I vetted all that at the time of inception, and I'm getting a paycheck, yes, it's going down, and I'm getting an update as to why it's going down, or if it's going up, why it happened, then I don't really go back to the OM every single quarter and look at, okay, well, your performance said, but you did, and da 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 da. So I just feel like as a limited partner, there should be a certain level of ease in your mind that says, I gave them the trust. If something horrible hasn't happened yet, I don't need to be worrying about it every single day as if it was my own deal.
Yeah, for sure.
Yeah.
That's just me.
So Alan, we always get people who they're still looking to do their first investment on this group. That's typically what we focus on, is how to get your first or how to get your next. If somebody's starting now, especially in this COVID situation, what would your best advice be for that person who is looking for that first or second or third investment to start?
I'd say you have to network, find reputable people, hang out with other reputable people. There's some, I probably get a new deal at least once a week. Some of them just scare me the way they're underwritten. There's so many deals out there. Don't feel you have to jump on the first one that comes across your desk. You can say no, and then those same people are going to have another deal in a few months and try to raise money from you again. So the biggest thing is find, solid people that are experienced. Yeah, that's my best advice.
So one of the things you mentioned there, Alan, is some of these deals you get scared by the way they were underwritten. So can you maybe go a little bit more specific from an underwriting perspective? What are some of the things that you look into in a deal, and what are some of the things that would scare you for a deal? Like, for example, maybe the syndicator is telling that they're going to reduce expenses too much, they're going to increase revenue too much. What are some underwriting criteria that you use to evaluate deals, and what would be something that would scare you from a deal from an underwriting perspective?
Yeah, it's things like you just said. There's some people that are going to cut expenses. Well, too much, that's not realistic, raise expenses. But a big one is a lot of deals, they're going to rehab half the units, like say 50% of the units over a 1 year period. It's just not practical to do that on a 200 unit apartment. You're going to have 100 vacancies. You're going to be your own competition once they're rehabbed and you're trying to lease them. So unless you're really saying there's going to be huge economic vacancy, like 20% or more, it's impractical. So the ones I like are the ones that are going to rehab the units over a long period of time, like 3 or 4 years, and go slow. As people move out, you can rehab the units. If there's something major like that foundation repair, it was over 16 units or so. Those are going to be down for a significant amount of time. So the numbers need to reflect that. And on a lot of the pro formas, like in Brad's group, people have the economic vacancy broken down. So it shows up. People put like 15 or 25% or some realistic number. For me, that's the biggest red flag I see right away.
All right, yeah, that makes sense. So Claudia, do you want to go over some of your questions?
Just thought somebody was going to ask a question. Alan, with the experience you have today, what would you have done different if you were able to go back? For the first deal,
I would have started earlier. This has been huge for us because I've always had 2 or 3 jobs. It's just, I've always had work to do. And I mean, even now I'm supposedly on vacation for a few months, but I still, paint the walls, redo wood trim. It's just my nature. So having passive investments, it's so freeing. I just can't believe it. I don't get phone calls every day, the garbage disposal broke or any of that. For me, it's huge. So I started earlier, and then I think the first couple deals I'd look for somebody with 10 years of experience, or at least gone full cycle of once or twice on something, 2 different deals. I think I'd look for that as a lead syndicator, not like a co-sponsor or co-syndicator, but as a lead. And I think I'd look for a lighter rehab. All of the ones that are just really light rehabs, new countertops and paint, new flooring, those seem to go much smoother financially.
Would you trade a lighter rehab for a lower return? Like if you had 2 deals, everything was equal.
Yeah.
One was lighter rehab and 8% cash on cash. The other one was a full rehab and 10% cash on cash. Would you go for the lower return, lower risk?
That's a funny question. When you say that out loud, I think it all depends on who's doing it. For me, it's more about who's the jockey riding the horse than anything.
Yeah.
And that's, if somebody's saying their performance 10%, I've changed to where I'd be happy with 8. If somebody's saying some really high cash flow number, they're either stole or they're stealing the property somehow, which you got to figure out how they found the deal, or it's not very truthful pro forma. Yeah.
Go ahead, Marcus.
Yeah, Marcus.
Yeah. So I noticed that you just said one of the things you would have done differently is started sooner. So my question is, I think you said you've been doing passive investment for a year now?
Yeah, mainly, like a year and call it a year and a half. Yeah.
So my question is, was it a long period of time before that 1 year start that you didn't know, that you just recently discovered? Like in my case, I found out about syndications a year and a half ago, and I started getting into it immediately, right? And I could have executed sooner, but I didn't even have no idea that it really existed. Was that the case for you? And if so,
I never heard the word syndication for apartments until about 4 years ago. And then when I did, I basically wasted 2 years trying to find deals and try to educate myself. And it all went so much faster once I got in the right group. I mean, I don't know much about Joe Fairless. I know Sumrock. He's got good information, but there's so many people and groups out there. There's so many coaches that I think I'd find one of these coaches and ask around how people like them and find one and use one. It's just the faster way to do it.
Yeah, I think at the end of the day, there are a lot of groups. They all have their pros and cons, and we're not biased on one or another. But I think I think you make a good point that find a group that you feel comfortable, right? Find a group that you trust the deal flow and they have a good criteria with that deal flow. Then you can at least understand how they underwrite deals, right? So hopefully everybody in that particular group, they all underwrite deals the same way, so you don't have to be relearning.
Yeah, and if you sit there and look at the finances behind it, if you invest $100,000, you get a 10% return. Well, it's $10,000 a year. Some of these coaches charge quite a bit. So if you only have 20 or 30,000 to invest, it's going to be a while before you get your money back from hiring one of these teachers or coaches, whatever people call them. But at some point it starts to make sense. But yeah, I wish I joined years ago.
Right. So Alan, when you are analyzing a deal, you already mentioned a little bit of deal killers, but would you like to dig a little bit deeper on what things will make you not to invest in a deal?
Yeah, for me, a lot of it is just, well, you have location, terms, and expandability. That's how I've always invested. I don't do that location. I pick the best location. When I buy the property, I try to get the best terms I could, and it would have to be expandable. Like I could bulldoze the house and build. We got some stuff. I got plans and permits to build like 48 unit apartment, but we sold it with plans and permits. We did that a few times, but we'd always look to add more units. So with the apartments, I kind of look for that too. Maybe the expandability is rehabbing the units and upgrading the rents.
Mm-hmm.
I think that's how you make the most money, is through forced appreciation, through fixing the place up a lot. So
you mentioned location, terms, and expandability. Why would you say terms? Can you expand on terms in the context of apartment investing?
Yeah, like the loan, you guys brought it up earlier. Mm-hmm. A lot of loans right now have huge prepayment penalties. So if somebody tries to sell in 2 or 3 years, whoever purchases the property has to acquire the debt. So 2 years ago, it was 5% interest on loans, and people were thinking that is so low, it'll never go lower. So they bought all of these apartments using terms where there's a prepayment penalty. Mm-hmm. Now here it is 2 or 3 years later, 5% interest loan is really high. Mm-hmm. And you really devalue the property when you try to sell it using those older terms. So,
right.
Yeah.
What about the sponsors' compensations and the fees? Do you?
Yeah. Some of that bugs me. I'm trying to wrap my head around it, but I've seen some as high as 3% acquisition fee.
Wow.
To me, it just seems too much.
Yeah.
I've seen a couple with 2%. I don't think I've invested in any of those. I really have to go back and look. 1% seems about right. I just ran into this lately. Somebody asked me to be a co-sponsor with them, and once I started drilling them down, they're not putting any of their own money in. Oh. So I'd be putting all of my money in it, and these other 2 guys wouldn't put any money in it. And again, with some people, I think I do that. It'd have to be really select few. But these 2 don't have a very good track record. So, yeah. If somebody says they're putting in, let's say $100,000, and it's a $10 million apartment, and they have a 1% acquisition fee, they're kind of paying themselves back. So are they really putting in their own money?
Yeah, how vested are they going to be to protect your money if they don't have anything on the deal, right?
And I try to be very polite, but I always ask, are you really putting your own money in? Aren't you just paying yourself back? Can you educate me on how this works? I'm just an idiot. And people will just start talking and say, oh, no, this is how it works. You charge a 2% fee and you make money on the close. You're actually in it, no money. I don't want to invest with people like that. So, a lot of times there might be a 1% acquisition fee, but it's spread across 4 sponsors or something. And then, it kind of dilutes it. So it's not, they still have skin in the game at the end.
Yeah. Go ahead, Marcus.
I had a question. On your, say your will not take part in anything above 1% approximate acquisition fee. My question is that tied to a minimum purchase price? In other words, how you know, on a 10 unit, they're not going to really make much on a 1%, but on a 300 unit, there's a lot of money being made. I'm just wondering whether that's a driver in that 1% number.
Yeah, it seems, the deals I look at, it seems to be pretty standard, 1 or 2% acquisition fee, and the deals we've invested in go from roughly 100 units up to 400 units. And you know, we talked about it earlier. If you buy a single family house and it goes vacant, it's not that big of a deal, or it's a huge deal because there's no income. In one of the 400 unit apartments that were invested in, 16 of the unit, 14 or 16 units burned down. Everybody lived, everybody's okay. But even with that, it's still around 95% occupied, and they can still make their pro forma numbers work. It's just astounding to me that you could have such a major event and it's still, and COVID, and it's still a pretty safe investment. It doesn't yo-yo up the stock market.
Yeah, I think that the deals we've seen perform the best in our 3 years in multifamily have been deals that had some type of catastrophe. With Harvey, there were a lot of deals down here that they got a lot of insurance money. They rehab 100% full class A quality, and they bumped the rents and they made a killing in a year and a half or 2 years. Yeah.
Right.
So Clayton, do you have a question?
No, I was just going to comment that I think when you're evaluating a deal where there's fees outlined in the compensation structure, I think that it's the fees in and of themselves are not a negative thing if there's some associated value transfer there. In other words, is there some extenuating circumstance, additional risk or additional work or additional, something to justify the fee because you want to make a couple extra bucks is not good justification. But, I've seen syndicators that have had incredibly arduous deals getting them to close that probably justified a fee of some type, an acquisition fee.
Yeah.
And then, I see people where the raise and the close is, smooth and no bumps in the road, and they're just taking the fee to try and, make a little money up front. So I think if it's well articulated what the fee justification is, and that makes sense, then fees are not negative. They shouldn't be seen as a negative thing, but more often than not, it's abused and there's not a good justification for the fee.
Yeah, there should be a story behind it. Yeah, always. There should be a story behind it that makes sense to you. The challenge is now that there's a lot of money in the market, a lot of money looking for investments to go to. I think I've seen an increase of those deals having acquisition fees. It was not that standard last year. So yeah, if you have one in front of you, make sure there's a good story behind it. And like Clayton said, there's a good reason for it, right?
And I think that if you, as a potential limited partner, ask the general partnership for justification and you don't get clarity, then that should be a red flag, right? That there should be transparency in that communication.
Yeah, I've always found the general partners, the sponsors of a deal, to be very open. At least the deals I invested in, they were, and some of them, they were, I guess they just weren't a good fit, but it's nice to be able to pick up the phone and talk to the lead sponsor and he'll call you back and you can have an adult discussion about the reasons.
Yeah, and for me, that's definitely one of my personal criteria is if the sponsor is not able to answer the question, what is the acquisition fee, how much of your own money you're putting on the deal, then for me, those would be like very standard deal killers for me, because I want to know that, yes, if there is a reason why they're getting an acquisition fee, I think I'm fine. If they found that property off market and they put a lot of time and money to close the deal, but at the same time, if the investment that the money that they're putting on the property is 1% or less, then they have no aligned interest on to succeed that property, right?
Right.
And so, Alan? Are you doing anything different now on when you're now considering? Well, I would say post-COVID, but maybe not post yet. During COVID, when you're looking at deals now, have you changed your criteria at all? Are you still looking for deals? Do you analyze them differently? Can you tell us about maybe how you did it a year ago and how you're analyzing deals now and how you look at deals differently, perhaps?
Yeah, now I'm just being really conservative, and we've been trying to save. Yeah, we got sidetracked and kind of stopped investing for about 6 months in apartments, but the deal we were going to pursue just didn't work out. So now we're back to looking to invest passively and trying to sponsor or co-sponsor a deal. So we're just being really conservative and slow, and there's no big hurry for us to rush out and buy something right now.
So when you mean conservative, can you clarify what that means? I mean, in contrast with maybe, like I said, before COVID.
Yeah. I think we're just looking for better returns. But along with the better returns, it has to be a certainty there of the return. Somebody just can't put a high return on a piece of paper and I'm going to jump in the deal. So that's kind of what we're doing, just slow and easy and taking our time. There seems to be a feeding frenzy right now of people buying deals. Some of them I've looked at, they don't make sense. One of them I know of, the person overpaid by a few $1 million compared to what an offer is that we were putting together to put in on the apartment. And then when I saw his pro forma numbers when he's trying to raise money, it was nowhere based on reality. So that's why we're being so cautious.
Got it. So we have a couple questions from V here. In your opinion, how much money should a general partner or a sponsor put into a deal?
It seems to me around 10% of the money raised. I really don't have a number. The more the merrier for me. 25% would be great. But yeah, I'd say 10% or so, at least.
And another question was, you mentioned you're looking for better return now versus before.
Yeah.
So can you classify what you mean by better return? Is like
mainly
a certain IRR, a certain cash flow, and
we're looking for cash flow. Cash flow covers all wounds. If a property has a high cash flow, like 10% or more, it can suffer huge vacancies, economic vacancies. It can suffer a lot more through downturns than if you're in Seattle and you're making a few $100s a month per unit on a $3,000 a month rent. If there's a hiccup, you're losing money and somebody has to pay for it. So with the syndicators, that's kind of what we're looking for is 10%. A 12% would be really nice, but I think in today's environment with the cap rate to interest rate spread, it's just not going to happen. So it'll be interesting to see.
So how often, just going back to your 10% answer there, how often on the deals that's coming to you, do you see that syndicators are meeting that? I know Marcos was making a comment that often he's seeing the acquisition fee just replacing their contribution amount.
Right. No, I'm just looking. Some of these aren't meeting, but when we Invested, it was going to be around like an 11% cash return, 11%, 10%, 8%.
No, I think the question is how often are you seeing sponsors putting 10% of the raise?
Oh, I'm
And-
not sure. I haven't really tracked all that, but I'd say almost every time anything that we invested in.
But just for reference for everyone, let's say the property is 10 million, the loan's gonna be 7.5, so the raise is 2.5 plus whatever capex you're gonna do. So 10% of that's gonna be around 2.5% of the whole value of the property. So if they're getting a 2% acquisition fee and then they're putting in that same 2%, it might look really good on paper, but they're putting your money in, right? Not their own money. So that's a good measure to figure out, okay, well, how much are they collecting on acquisition fees and how much they're putting in from their own money. And I think because Alan is mostly investing in larger deals, more than 100 units, usually there's going to be more than one sponsor, right? It's going to be co-sponsors and sometimes even KPs. So that team usually is going to put together more than the 2.5% of the whole property value. Yeah.
Yeah. Well said.
Clayton, do you have a question or comment?
I was just going to comment to whoever it was that asked about, you know, how often you see the GP put in, you know, 10% or more. I try and attend opportunity webinars, even if I know that I'm not going to invest or I'm not interested in investing or I don't have the money to invest. I try and attend just because I feel like you can always learn something or maybe think of something that, you know, it's a valid use of time, you know, to educate yourself. But what I see a lot, I mean, more often than not, is the GP not disclosing their contribution until someone specifically asks them.
Mm-hmm.
Yeah.
And I would feel, you know, if a sponsorship team was forthright in sharing, you know, what skin they have in the game, I would think instill confidence in potential LPs because they obviously believe in the deal enough to, you know, want to put more of their own money in. So I've just seen that it's not typically disclosed until somebody asks directly. And then sometimes you get a straight answer and sometimes you don't.
Yes.
So Alan, for a new investor, do you have any book or podcast or system material that you'd recommend somebody that's trying to learn more and get better?
Not really. I really don't. This is my first podcast type thing I've ever done.
So you recommend it?
For me, I'm more about mindset, motivation, and that kind of thing. I read a ton of books about all that stuff, Think and Grow Rich and Greatest Salesman in the World and all those good old books, you know. I mean, I don't want to keep saying Brad, but I just joined Brad's group and I kind of enjoy it. I have my differences with some stuff, but it's so minor, it's not worth bringing up, you know.
And I think that's a fair point. Like everyone learns differently. And I think some people are really good with podcasts. They have the time, let's say when they're driving or something like that. Some people are really good with books. But I think those ecosystems of mentors, it might be Brad or Rodcliffe or any of those, I think those have a really nice appeal to every type of learning. So that's a great advice. Just check out a couple of those and see where you think you fit best and try it out.
Yeah, the best returns I've ever gotten is, I call them my elders, but there's some people I know in Seattle that they've been in, you know, they're in their 70s now. They've been investing in real estate since high school or whatever. And I always try to buy them lunch, take them out to lunch once a month. We talk about real estate taxes, development, all kinds of stuff. And I've gotten the most out of those kind of direct one-on-one meetings than anything.
So when you're on a webinar, Alan, do you have certain questions that you would ask, you would always ask the sponsor in case they didn't cover during the webinar?
No, I generally don't watch the webinars. I download it, I watch it afterwards. Most of the webinar, they're just going through their slides and there's not much in it. So I'll watch it and then I'll just call them up and have a talk one-on-one. I get more out of that than.
But is there, so let me rephrase that question. Is there a particular questions that you would ask during that conversation? I mean, what are maybe some of the things that you want to get out of seeing a deal that maybe it's not answered on that you want to ask?
Yeah, I say it depends on each webinar, or on each deal. But I mainly just have a conversation with them. If something seems out of line to me, I just ask, how do you justify this? And I always start with, I'm new, I'm not trying to hold your feet to the fire. And I just try to have a polite conversation. Even if I think it's full of baloney, I don't tell them that. Yeah. Even if I'm not going to invest in the deal, sometimes I'll still call them up and just ask questions to try to figure out how they justify their numbers. And then the answers are shocking to me, but yeah, I don't remember any of them particularly off the top of my head, but
Wow.
yeah.
So,
Alan, how much fact checking do you do? I mean, are you doing your own underwriting with Sunrock's analyzer? Are you, pulling a CoStar report? I mean, how much are you really, making sure that what's being proposed is legit?
I always try to go back to the brokers' marketing stuff. I go through that and see what the brokers are saying, and then see what the syndicator's pro forma is. Most brokers, I mean, I hope nobody here is a broker, but commercial brokers don't seem to live in reality on a lot of stuff. I've been looking at deals and I'm just, they're taking the T12, the last 12 months income expenses, and they're upping the rents around 4 or 5% from what the T12 is, and that's their starting point. And then they add to it another 10% for the pro forma for the first year. So now you're up 15% from reality. And how can you raise rent 15% and not have mass people moving out? So I see that stuff a lot.
Yeah, so I think we always need to understand that at the end of the day, brokers are salespeople, right?
Yeah.
So that's a sales material for them. So not necessarily reality.
Yeah, if you're really worried about the neighborhood, at first I wasn't very comfortable at all with C-class properties because I've always invested on the other end. So Google Earth is phenomenal, and a website called citydata.com.
Mm-hmm.
You can go in there and see what the median income is, see if it jives with the marketing materials, and it only takes a few minutes. But Google Earth and drop in that Google Maps and drop in the little guy to walk around the streets, it's fun. You can see police pulling people over, and you can see guys stealing stuff. It's sad, yeah. Like, that's not my neighborhood. And I mainly do that for the properties I'm looking at buying than, fact checking.
good. Alan, what makes you want to be a repeated investor with one sponsor? Why would you go again and invest with someone?
Mainly honesty and integrity. I have one that we're involved with. I get about a 75-page PDF every month with every dime spent, all the expenses, the rent roll. He's really transparent, and it's performing as advertised. So, if something's not performing as advertised, there could be a valid reason for it. Like, units burned down, COVID, mass, unforeseeable unemployment. So, yeah, most of the people I'm invested with now, I would reinvest in. There's only one group that I wouldn't invest in again. So, yeah.
Yeah.
I'd invest with the Rubios all day long.
Thank you, Alan.
Thank you. That was going to be my next question. What do you like to see on the reports, on the monthly report?
I really love it when with all this property management software, the amount of information is incredible. It can be just hit a report button and you can have everything, the rent rolls, all the expenses, what was pulled out of petty cash and why. And it's just nice to see all that. I don't study it, but I got to admit, I go through it just out of entertainment factor. Like somebody took $5 out of petty cash to go buy a piece of plumbing or something, a piece of copper plumbing. I just found that amusing. Somebody actually tracked $5 on a, on a $250,000 a month thing.
Yeah.
75 cents of those $5 were yours.
Yeah, I know.
Right. And the more they show you, the more transparency there is. So
yeah,
you see a report full of even the checks or the checks that were written or all the little details, you will feel more comfortable.
Yeah, and
they're showing.
Yeah, and how the tenants found the property. Was it Google or apartments.com? What do they like or not like when they stop by the property? There's all of that data. If the property managers will type it in,
yeah,
it's just a treasure trove of information that I think if they're willing to publish it, then that probably means that the sponsors are actually going through reading it too, trying to improve the curb appeal if they don't like it.
All right, folks, do you guys anybody have any other further questions before we start wrapping up?
Yeah, I think Marcus's question on the chat, I think that would be a better conversation one-on-one if you want to reach out to Alan through email or figure out like a phone call. Yeah,
did he share his email already?
Yes, and I'll put it again here on the screen in a second, Marcos.
Okay.
And so everyone, I posted the link to our YouTube channel. So if you can, please subscribe. So in case you miss a meeting, you can watch it after. And I want to remind everyone that we always meet on the first and third Wednesday of every month. So first Wednesday is focusing on syndicators, and the third Wednesday is focusing on passive investors. So our next one is going to be December 2nd. We are going to skip a couple meetings because of the holidays after that. So then we'll come back on the third Wednesday on January 20th. So December 2nd and January 20th. And if you saw us on Facebook and join us through there, please go to multifamily021.com. So if you sign up there, then we always send emails and you get notified of when we post new meetups. And with that, Marcos, this is Alan's email if you want to take a screenshot. So thanks again, Alan. We appreciate you spending the time with us. I know you are enjoying sunny Hawaii there, enjoying your nice vacation, and you made some time to meet with us, so we definitely appreciate.
Yeah, thanks so much for having me. I've never done something like this, so it's kind of fun.
Thank you for watching this week's episode of the Multifamily 0 to 1 Meetup. Join us live the first and third Wednesday of every month.